So I can start. My name is Angela Omogbeme, like introduced from University of West Georgia. Um, most of my career has been in banking, financial services, and research. So there's a problem in the financial industry, or there used to be a problem working in the bank, and it's about credits and loans. What informs the decision for us to give credits to customers? So for that reason, I decided to go into this research. Briefly, let me do a brief introduction about what I'm going to be talking about in a few minutes. The first one is the black box problem. And what does this mean? The traditional predictive analysis in banking, when a customer is about to be given a loan, it could predict if the loan should be approved or not. It's just like a coach trying to train a team. You want to determine what determines the success of the team. You input the information into the computer, it gives you an output. You don't know what happens within the computer because the computer does not explain the reason for picking those features that are responsible for the success. So that is the same thing with credits and loans when it comes to predictive analysis. We know the outcome, it is accurate, yes. We know if the loan should be given or not. But what about transparency? What about fairness? How do we know if there is bias or an error has been made? So, more often than not, the traditional machine learning models are accurate, but there's no explainability. There's no transparency. It doesn't explain why those situations or those decisions have been made. And this calls for concern for regulatory authorities like the GDFR and the FCRA. They sometimes need to find out why some decisions are taken to be sure that there is no bias. So that is the gap I'm trying to identify and resolve in this research. So this research is a bit technical, so I'm going to explain it in real scenario so that we can appreciate the remaining parts of the research presentation. So this is a real life situation of a guy, James. He's a bakery owner. As far as he's concerned, he has strong savings accounts. He has everything going on for him. He has a good repayment history and he needs loan to expand his business. In traditional predictive analysis in banking, the algorithm will just say, I'm sorry, James, your loan has been denied. James, frustrated and losing trust, will move his account to another bank again, because there's no explainability as to why that loan was denied. That is for the traditional predictive system. So, what are the research objectives here? To be able to support the new regulatory compliance, there's regular updates these days from regulatory authorities to explain fairness, why decisions were taken, why it was approved, or why it was denied, to ensure fairness and accountability, to ensure proper sustenance. Marginalized groups, more often than not, are being wriggled out of loan due to wrong decisions. So to be able to have everyone participating, inclusion of the marginalized group, that's another objective of this research project. And also to look at to identify the key risk drivers. We know that the loans should be given or not based on the predictive analysis. But what are the key drivers? What are those features? What are those things that make us know the wrong, the strong indicators of whether a loan should be approved or not? Is it the credit history of the individual? Is it the marital status? What are those? So to mitigate again this bias and improve fairness in credit scoring, we decided to use a new model which is more advanced than the traditional machine learning models, and that model is known as SHAP. So we are going to see how SHAP works and how it's been able to address the issue of trustworthy AI, so that when AI takes a decision, we'll be able to trust it more based on the outcomes. So here are the problem statements: accuracy versus transparency. Advanced model like XGBoost, that is the traditional machine learning model, it offers high accuracy because if you look at it with high human point of view, it gives a good prediction as to whether a loan should be given or not. But it lacks interpretability. It doesn't explain why the loan has been given or not, creating the black box problem, which I spoke about earlier. And there's another problem with the regulatory compliance bodies. How do we even justify a claim that a loan was denied and it wasn't based on bias, maybe the person's race, skin color, gender? How explain to the regulatory compliance? So these are what we're going to be looking at. So a lot of literature reviews have been done on this, but to save time and for the purpose of this presentation, I'm only going to mention about four of them. The first one is from Michel. He states that lack of transparency in AI algorithm, no transparency, and that is a major challenge. And the second researcher, Yo, explained that explainability is a key priority in financial AI. There is need to build trust and for us to be able to explain to our clients and the regulatory authorities why those actions are taken. Then AI financial services easier to access also brings new risk. Then the last one is integrating sharp and line techniques in credit risk analysis improves model interpretability. So this was the methodology. This data set is empirical and gathered from German credit data from UCI repository. I used a total of 1,000 applicants to do this analysis with 20 different features like income, the savings they have in their accounts, the gender, the age, and all of that, 20 different features to do this analysis. And it was fed into the machine using one hot encoding, that is the language the machine understands, the computer understands. It was standardized into the normal scale so that they are all on the same scale. And I made sure there was a class balance. Then SHAP was the model approach in this case, rather than the traditional learning. We decided to use SHAP to see how much it will be able to interpret the default predicts the accuracy. So this is SHAP and XGBoost explained briefly. XGBoost is an ensemble model, and what this means is that it takes different models together, it merges them and makes its decision based on that, and that is what makes it very accurate because as the models learn, they improve. So XGBoost is a very accurate model, even though it's traditional. Now we have SHAP. SHAP has advantages. The first one is that it predicts globally. It looks at all the features in the data set and it predicts. It can also predict individually. It looks at a particular case study of a customer. That means we can explain to a customer or a consumer directly why the loan has not been approved, what features are strong, what can be improved to make that loan approval stronger for approval or denial. So why this matters, like we said earlier, is that it's more trustworthy and it's more transparent. So these were the key findings based on the traditional predictive machine model. As we can see here, different models were used, but XGBoost still remains the highest performing at 78%, even though it still has some drawbacks, which this research addresses. There's no explainability. We only know that it's accurate. So this is SHAP in action. And this is an example of an individual credit application, as we can see. The blue shows that it moves towards the approval, and the red shows that it moves away from approval, it moves towards denial. So this is a particular case study of an applicant. And we can see that it really explains the different features and outcomes and how strong and weak they are. If the savings account balance is high, for instance, that is the longest blue that we can see, there's a strong indication that this customer's credit will be approved. But let's look at the other side. The credit amount is $15,000 in red. It pushes it to the denial field, meaning this credit amount is too high and it's kind of risky. So this loan might be rejected. And let's look at another red bar, the credit history. If the credit history is poor, definitely it pushes it towards the red, meaning there is a tendency that this loan will be denied. If the duration is 24 months, that's a long-term loan. The longer the term of the loan is, the more, even though it's not a strong indicator, but it's still red. The longer the term of the loan is, the more negative that is. Because as you can see, this individual is a skilled employment worker. So there may not be continuity. There may be tendency that in 24 months, he might not really be able to fulfill this credit obligation. So that makes it negative. So this is what SHAP does basically. It brings out the most influential features that we can see. So this is more explainable to a client or a customer, unlike the traditional machine learning models, because it provides a global insight of all the features. These are all the features that we have, and these are all the insights, and it goes ahead to give an individual credit explanation and decision on each client. So, what is the regulatory relevance? For the regulatory bodies here, the FCRA, GDPR, and the ECOA, basically, it makes the process more transparent. It makes reporting easier. When we have adverse action notices, for instance, we have a justification, we have a reason to explain to the regulatory bodies based on the SHAP model why the loan was approved or not. And this will prevent regulatory sanctions. So this is a practical approach and a summary of what I'm talking about. Trustworthy AI, which is the new advanced AI now, takes into account transparency, fairness, and accountability. It also helps the customers boost their confidence because the customer would see holistically the criteria that are strong and the ones that are weak. It will ensure that there are no biases. So these are my recommendations for institutions like banking, financial institutions should incorporate SHAP into their workflows because it is not only accurate, it's explainable. It goes a long way to explain the features and why those decisions are taken. And for regulatory authorities too, this is a good interpretability standard which I think should be incorporated into the policies. Banks should employ SHAP because it explains more and it's more transparent. And for developers, they should build real-time SHAP systems and also enhance the workability to ensure loans are properly approved or denied, decisions are taken properly. So, in conclusion, explainable AI enables transparent credit modeling. XGBoost and SHAP, they are very powerful as we can see. They predict very well. But SHAP goes an extra mile to explain why decisions are taken. Trustworthy AI isn't just something that is theoretical. It's implemented now and it shows transparency, and financial institutions should adopt SHAP. Thank you very much.